You can turn $500 a month into over $100,000 in just 10 years. And you don't need to be a stock market genius or have insider information to do it. You just need to stick to a simple plan. Here's how it breaks down. Why $500 a month matters. $500 a month works out to $6,000 a year. For a lot of people, that's a realistic target once you cut out expenses you don't truly value. When you commit to investing that $500 every month instead of spending it, you're building a habit that works quietly in the background. It's much more powerful than throwing in one big chunk of money once in a while and then forgetting about it. The difference between small, steady contributions and random large deposits is huge. If you put $20,000 into the market once and never add it again, your final total after 10 years wouldn't come close to what you'd get from adding $500 every month for those 10 years. That's because regular investing keeps your money working and makes the most of both market ups and market dips. When prices drop, your $500 buys more shares. When prices rise, the shares you already own gain value. This ongoing rhythm is what sets you up for the long-term benefits of compounding. Compound interest explained. Simply, compound interest is talked about like it's some magic trick, but it's actually very straightforward. It's when the money you've already earned starts earning more money. If you earn $100 on your investments in the first year, the next year you earn interest on both your original investment and that extra $100. Over time, this snowballs. The formula looks like this. P is how much you put in each period, R is the interest rate or return per period, and EN is the number of periods. What makes compounding so powerful is the way it accelerates over time. In the first couple of years, growth feels slow, but by years 8, 9, and 10, the increases are much larger because your returns are being reinvested and earning their own returns. Albert Einstein famously called compound interest the eighth wonder of the world because it can turn modest contributions into life-changing sums. The key is to start as early as possible. Asset class comparisons over 10 years. Now let's compare exactly how $500 a month grows over 10 years in different types of investments. If you keep your money in a typical savings account, you'll earn about 0.57% interest based on the current U.S. national average. Over 10 years, your $6,000 per year contributions will grow to roughly $62,725. That's only about $2,725 in growth over your $60,000 in deposits. Inflation will eat away most of that gain, which means your purchasing power will barely improve. Savings accounts are great for short-term needs and emergency funds, but they're not going to grow wealth meaningfully over a decade. If you put the same money into bonds earning around 3% to 4% annually, your 10-year total would be roughly $71,000 to $75,000. That's more than a savings account, and it's steady growth with relatively low risk. Bonds don't usually have the big swings of the stock market, but they also don't have its higher returns. They're like a slow-moving train that gets you where you're going without much excitement. For people who value stability above all else, bonds can be a solid part of the portfolio. But on their own, they won't double your money in a decade. A broad stock market investment like an S&P 500 index fund historically returns around 8% to 10% per year. That means your $500 a month could grow to somewhere between $91,000 and $104,000 over 10 years. That's a significant jump from bonds and savings accounts. The reason is that the stock market over long periods tends to rise even though there are short-term ups and downs. This is why so many financial experts recommend low-cost index funds for building wealth steadily. You're essentially buying a slice of the largest and most successful companies in the country and letting them work for you. Then there are high-growth options, like certain tech stocks, AI-focused companies, or cryptocurrencies. In a strong decade, these can average returns of 15% to 20% per year. That could turn your $500 monthly investments into $130,000 to $155,000 after 10 years. The potential gains are huge, but so are the risks. These investments can drop 40% or more in a bad year. If you can't handle watching your account balance swing wildly, these might not be for you. Even if you do invest in them, most people limit high-risk assets to a smaller percentage of their total portfolio. Risk versus reward breakdown. Here's where understanding risk and reward really matters. The bigger the potential return, the more volatility you have to tolerate. That's not just a financial challenge, it's an emotional one. Watching your investments lose value quickly can push you into making decisions that hurt you in the long run. Selling during a crash locks in your losses, and if you're not in the market when it recovers, you miss out on the rebound. This is why discipline is as important as choosing the right investments. Diversification is your best defense against risk. This means spreading your investments across different types of assets. Some in safer places like bonds, some in steady growers like index funds, and some in higher risk opportunities. If one part of your portfolio takes a hit, the others can balance it out. Essentially, you're not putting all your eggs in one basket because sometimes baskets break. Another smart approach is dollar cost averaging. This means you invest the same $500 every month, no matter what's happening in the market. When prices are low, your money buys more shares. When prices are high, you buy fewer shares. Over time, this smooths out the price you pay and takes the pressure off trying to guess the perfect time to invest. It's a proven way to reduce the impact of short-term market swings. The most important thing you can do is stay invested. If you pull your money out during a downturn, you risk missing the best days in the market. 10-year snapshot. So what does all this look like after 10 years? Side by side, the differences are clear. A savings account leaves you with around $62,725. Bonds get you to roughly $71,000 to $75,000. An S&P 500 index fund takes you to about $91,000 to $104,000. High-growth investments could land you between $130,000 and $155,000. That's the range of possible outcomes depending on your choices, your risk tolerance, and your discipline. Starting is easier than most people think. Open a brokerage account, set up automatic monthly transfers of $500, and put the money into your chosen investments. If you want to begin right now, check the link in the description for interactive brokers. When you sign up using my link, you can get up to $1,000 of free stock. That's an immediate boost to your portfolio before you've even made your first deposit. From there, it's all about letting time and compound interest work on your money for you. How much do you currently invest every month? Or are you thinking of investing? Let me know in the comments below, and don't forget to like and subscribe while you're there.